news in Tesla. They reported earnings after the close, held their earnings call. I'd say it's a pretty surprisingly weak report, even for us, relative to our expectations. Auto revenue, the growth is only about 5%. That sounds very GDP-ish. Gross margin and operating margins fell 700 and 900 basis points year over year, respectively. Really, no one else in this industry is having issues of that magnitude. This is very much driven by the price cuts, and I think what's very obviously an intensely competitive market for electric vehicles. You can buy a Rivian, you can buy dozens of other really interesting electric vehicles. 55 cents versus 95 cents a year ago, missing consensus pretty sizably. But the fact is that this is an auto company, that 2024 is going to be a challenge because they don't have meaningful ramps of new auto production, auto and truck in the case of Cybertruck. They are facing competitive pressure in a capital intensive, highly competitive industry, which is making cars, which is their primary revenue source and the reason they're struggling in this period of time. And we already know it's going to be more challenging in fourth quarter because they've already lowered prices further. Interest rates are now higher. They went on a tirade about interest rates and borrowing costs and monthly payments, which they do basically every quarter for the last year. So, it looks like new and interesting, like something changed, that this particular quarter has been evident as a weak quarter. Consensus was simply too high. We talked about that in our themes call. Because we know prices, we can look at the pricing, and we know deliveries, and they reported deliveries. So, this is going to get worse again this quarter. We already have visibility into that, unless they suddenly try to raise prices, which would be very difficult at this point. They've already lowered them. So it's a place where we remain bearish. I am still shocked by the resilience of the stock. I think Keith has gone through that, talking about the Magnificent Seven and some of the just drivers that underlie the persistence of this valuation and this relative strength in Tesla, despite what's, a 44% drop in EPS and missing consensus, and a company that lacks new products. And it's also worth noting that even as the Cybertruck ramps up, which I think is going to be very hard to do, given that, just look at it, right? That's going to be a truck that's hard to make. There's a reason why cars don't look like that, and refrigerators do. Refrigerators don't move and bounce around and get in accidents. And if you dent the front of your refrigerator, it's not great. But that beside the point, even if it ramps to full production, it's not the same kind of volume that they have in place for the 3 and Y, right? It just doesn't move the P&L needle. And they also, in terms of capacity, they're pushing out this thought of a Mexico plant. They have too much capacity now. That's why they're cutting prices. So it looks really negative and problematic. The charging network is increasingly open. So to the extent that they had a competitive advantage with more charging locations, that's increasingly not, because of some various provisions, it's not going to be as much of an advantage. So highly competitive market, fewer differentiating features, no near-term needle-moving new products is really the big issue, because it's a car company and they want to talk about their robot, and they want to talk about having the greatest AI team in the world and whatever. And maybe that sells some stocks, but it certainly doesn't, shares of stock, but it doesn't generate the income statement that this company needs. So I'll just leave it there. It looks, down 7-ish% pre-market.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.